So, what is a company really worth? I mean, we see stock prices flashing on our screens all day long, right? But that's just the market's opinion at one specific moment. Today, we're going to go a little deeper. We're going to look at the tools that analysts use to see past that price tag and figure out a company's true fundamental value. And that brings us to the biggest question for any investor, really. Is a stock's price the same thing as its value? Well, the short answer is almost always a big no. And, understanding that difference, that's the key to the entire world of investment analysis. Exactly. You see, the market price is just what a buyer and seller last agreed on. It can get pushed around by news, by panic, by excitement, you name it. But value, what we call intrinsic value, that's what a business is actually worth, based on its assets and, more importantly, its ability to make money. Valuation models are just our way of trying to pin that number down. Okay, so a simple place to start is with something called net asset value, or NAV. Just think of it like this. If you sold off everything the company owns, all its buildings, its machines, and paid off all its debts, what's left for shareholders? That's NAV. But here's the catch. Most healthy companies trade for way more than their NAV. That extra bit is called goodwill, and it represents all the intangible magic. The brand's reputation, great management, loyal customers, all the stuff you can't just put a number on in a balance sheet. All right, so if NAV doesn't tell the whole story, how do we value that magic? Well, our first stab at it is to focus on the most direct thing you, as a shareholder, get from a company: cold hard cash in the form of dividends. Let's see how we can figure out a company's value based on the dividends it promises to pay out. The dividend valuation model is actually pretty simple in theory. It basically says, hey, a share of stock is just a little machine that's going to spit out cash to you every year, forever. So the true value of that share is just the grand total of all those future payments. But with one little tweak. We have to account for the fact that a pound tomorrow isn't worth as much as a pound in your pocket today. And the formula itself is pretty straightforward. You just take the dividend you expect to get, that's D, and you divide it by your required rate of return, K. So, for example, let's say a company pays a 10 pence dividend and investors like you want an 11% return for taking on the risk. You just do the math. 10 divided by 0.11 gives you a value of about 91 pence per share. Simple enough, right? But here's where our simple little model starts to fall apart. Because think about it. Very few companies just pay the same flat dividend forever and ever. Good companies, successful companies, they grow their profits. And as they do, they grow their dividends too. If we ignore that growth, we're missing a massive part of the story. So to fix this, we need a better tool. And this brings us to the Gordon Growth Model, which is a really powerful upgrade designed to do one thing: account for growth. This is a game changer because it recognizes that businesses aren't static things. They're alive, they're growing, and that growth is a huge, huge part of their value. And what's so cool about this model is how elegant it is. It takes our old formula and just adds one new ingredient to the mix: the letter G, which, you guessed it, stands for the constant rate that we expect those dividends to grow, year after year. So here's the new and improved formula. The share price is still the dividend, D, up top, but now on the bottom we have our required return, K, minus that super important growth rate, G. Now this tiny little change in the denominator is about to make a massive difference to our final number. And check this out. This shows you just how powerful growth really is. Let's take that same company, but now let's say its 10p dividend is going to grow by a steady 5% every single year. All of a sudden, its value leaps from 91 pence all the way up to £1 and 67 pence. That's the power of compounding growth, all captured in one little calculation. Now, dividends are great, don't get me wrong, but they're really just an output, right? It's what the company decides to give back to you. So let's pivot and ask an even more fundamental question. Is the company's internal engine, is it actually creating any real economic value to begin with? For that, we turn to this really cool metric called economic value added, or EVA. The best way to think about it is like a company's internal report card. It doesn't just look at profit. It asks a tougher question. Did our profits actually beat the cost of all the money, both from loans and from investors, that we had to use to make those profits? So here's how it works. We start with the company's core profit. That's called NOPAT. But then, and this is the key part, we subtract a charge for all the capital the company had to use. And that charge is basically the total money invested times something called the WACC, which is just the average interest rate the company pays for all its financing. In short, it's the profit minus the true cost of doing business. So what you're left with is really simple to understand. If the final number is positive, then the company is a wealth creation machine. It generated true economic value that year. But if that number is negative, well, even if it reported a profit on paper, it was actually destroying shareholder value because it didn't earn enough to cover its cost of capital. Okay, so now we have this amazing internal metric, EVA, that tells us how the company did last year. But a stock's price is all about the future. So how do we connect this internal report card to what the market is actually thinking? What's the final verdict?
And that's where market value added, or MVA, comes into play. MVA is simply the company's total market value minus all the cash that was ever put into it by investors. What that number really represents is the premium the market is willing to pay. It's the market's collective bet on how much value the company is going to create in all future years.
And this comparison just makes it crystal clear. EVA is the internal report card. It's looking backward at what happened in a single year. MVA, on the other hand, is the market's external judgment. It's a forward-looking bet on every single year to come, all rolled into one number. And this leads us to the final piece of the puzzle, the part that you can actually use. An analyst's job is to try and predict a company's future EVAs and figure out what they're worth today. If that number you calculate is bigger than the MVA that the stock price is suggesting, well, that might mean the market is being too pessimistic. You may have just found yourself a bargain. So we've gone on this whole journey, from simple dividends all the way to these complex models of value creation. But it all leaves us with one last really big question to chew on. In the world we live in today, where so much of a company's worth is tied up in things you can't touch, like brand power, data, intellectual property, are these number-crunching models ever really enough to capture the whole story? Something to think about. Thanks for tuning in.